Hello, everyone, and welcome to today's lecture on international trade and supply chain management. I hope you're doing well. In today's lecture, I will basically be focusing on four key areas. The first one will be currency issues and financing. A lot of these issues occur during international trade, and I'll be talking a little bit about how companies can deal with currency fluctuations. We will learn about how working capital can be managed. You by now should be familiar with the cash conversion cycle, and you should have a good understanding that many times what happens in companies is that they run out of cash. Even profitable organizations sometimes run into situations where they run out of cash and therefore have to go out of business. So it's very important to manage working capital for companies, and I will be talking about how that can be done in the short run and in the long run. Next, I'll be talking to you about something called a letter of credit, or LOC. And if you end up having a business where you import or export, or you work for a company that imports or exports, you will definitely be, hearing a lot about letters of credit. And also I'll talk about some other payment arrangements that are made in international trade. Finally, I'll be summing up with, some global supply chain design strategies that are used internationally. These are quite interesting in my opinion. So we'll wrap up the lecture with that. So without further ado, I'm going to jump into the whole topic of currency and fluctuations. And, any currency in the world does see fluctuations. In this particular slide, you can see this is the price of euro in USD. And because of the financial crisis around 2008, you see that the stock market in Europe crashed. And that basically had a very negative effect on the price of euro. And so the value of euro dropped down significantly and eventually recovered. And you can see that the period of recovery, lasted a couple years. So somewhere around 2009, mid 2009, it recovered, but then something else happened. So we can see that there's a lot of, fluctuations. Many times companies try to put their money in save themselves from this fluctuation. So they invest their money in various financial instruments. But it's unfortunate that in the world of international trade, business is hit by currency fluctuations. For example, if there's a business that is based out of Pakistan, they in majority of cases will price their product in rupees. So if the value of the rupees shifts, then customers may either, if it shifts, then in some cases, customers may be very happy to buy the product. But if it goes negative, if it goes against the Pakistani rupee, then the price of the goods may be more than what the customer is willing to pay, and they may shift to another seller. So these are very real things that do happen, and in business, especially in import and export business. And it's important to really know about these things. Now in this slide, this is the value of yuan, or the price of yuan in USD. And we do see that there has been a shift here as well. There has been an increase of 12%, around January 2009, and then a decrease around 2017. Now, if you notice, the yuan's value is not as volatile as, let's say, the euro's values or price fluctuations. And the reason is that the Chinese currency is controlled. So therefore, it is less volatile. But that being said, this volatility is still something that companies are having to deal with on a daily basis and figure out how they can use it favorably. And if in case they aren't able to, use it favorably, how can they hedge themselves or cover their risk. So in this slide now, I'm going to talk to you just a little bit more about exchange rate risks. And I want to give you an example of, let's say there is a, company, and it costs them um, $10,000. So it's a US company. It costs them $10,000 to make an electric motor. And they are able to sell that motor for $11,000. So by and large, this company, this electric motor company is quite happy to make $1,000 profit on every single electric motor that they sell. Now, let's say what happens is that they find a customer in Europe for their electric motors. And the European customer says, look, guys, I'm very happy to buy your electric motors. I want 500 of your electric motors. And let me make a quick calculation. So based on today's exchange rate, that means I will pay you 7,333 euros for every single electric motor that I buy. And the way they did that is they took, 11,000, which was the selling price, and they converted into euros. So basically they divided it by the exchange rate of 1.5. And so they said, okay, we'll pay you 7,333. And so the US company is really, really happy because they realized, look, they'll be able to sell 500 of their motors, and they're going to be, calculation, they realize they're going to be able to make $500,000 in profit. So they're really, really happy. And they decide to, move forward with this transaction. But what happens is, oops, 2 months later, when it's time to actually deliver the motors, the value of euro has gone, has appreciated. So now €1 is only equal to 1.3 USD. So now in this case, what happens is that the price that they're going to be giving is actually going to be going down. So if we make a quick calculation, now instead of getting 11,000 for every motor that they were selling, they are only going to be able to get 9,533 for every single motor that they sell. So they were expecting a lot more. They were expecting $11,000, but because of the exchange rate shift, they're only going to be able to get 9,533. Well, that basically means that they're going to be making a loss of $467 on every single motor that they sell. And that means that instead of making a $500,000 profit on this transaction, they will be making a $234,000 loss. And the reason is that, look, the price was decided that they were going to be paying in euros. So whatever, 11,000 converts to on the day of delivery, that's what they're going to pay based on the exchange rate. Now, because of the fluctuation, you see that at the time when the original transaction was agreed on, it seemed favorable, but because of the currency exchange fluctuations, it became a very unfavorable proposition. So this is just an example of the exchange rate risks. And sometimes it's very difficult to get out of these transactions because you've made a commitment, you have an agreement, a legal document has been signed. So companies sometimes get hurt really bad. So the big question is, when do you get hurt? In what situations do you get hurt when, currency exchange rates are involved? Well, there are two basic factors that play in. First of all, usually there is, two different currencies in the transaction. So for example, in the last transaction, there was the USD and the euro. So if it's, everything is, let's say, the whole transaction is done in just dollars, and, both parties say, look, the price will be X dollars and we will pay Y dollars, then there's no real risk there. But when you're dealing with there is a risk. The other thing is that there's such exchange rate risks usually occur when there is a time delay between the beginning and end of the transaction. So let's say, for example, you know, the transaction happened in today and I end up paying tomorrow. There's probably not going to be much of an exchange rate risk. But if I wait and I have to make, let's say, the payment a year later or 2 years later, then there's a very, very high possibility of exchange rate fluctuations playing in, and it could go in my favor, it could go against me. So keeping all of this in mind, in the financial sector, there are a number of different products that were launched many, many years ago now, and they're called derivatives. And so a lot of companies like to take advantage of derivatives to hedge themselves. And hedging basically means, reduce their risk, minimize their risk. So let me give you an example of a situation where let's say Jane, there's a lady Jane, and she has invested, she basically knows that she's going to, receive 1 million euros on June 1st. Now, she is really excited about receiving this 1 million euro amount because she had invested her money, and she decides that she wants to buy on June 1st, she wants to buy some luxury item for 1.4 million dollars. So she has her eye on what she wants to buy. She definitely wants to buy it for 1.4 million dollars. She thinks it's a great investment. Perhaps it's a house that she's looking to buy. And so she tells the buyer that, look, on June 1st, I'm $1.4 million in my account and I will pay you on June 1st. But all of a sudden, somebody, let's say, goes and tells Jane that, look, you're expecting, today is March, who knows, what happens to the exchange rate by the time June rolls around. So maybe you will get the 1 million euros, you know that for sure, but how do you know that it will convert into 1.4 million USD? Because at that time, if the exchange rate goes down, then you may only get maybe 1.2 if the exchange rate is 1.2 to euro. 1.2 USD to a euro. So it could be that you only end up with $1.2 million, and so you won't be able to buy the house. Well, in that case, Jane can go to the futures market and she can buy a futures contract. And according to that contract, she'll pay a small fee for it. But according to that contract, no matter what happens with the currency, no matter what fluctuations happen in the currency, she can go into the futures market and say, here's my instrument. I had bought the future contract. So I have 1 million euros and please pay up 1.4 million USD. No matter what the exchange rate is, she will get 1.4. Now, if it's favorable, if let's say the exchange rate actually goes up in her favor and it's 1.7 instead of 1.4, then she can say, I don't want to use my futures contract. Thank you very much. But if it goes lower than 1.4, then she can use her futures contract, which can really save her a lot of headache. So these contracts are available for many companies and they can be bought. The issue with them is that there is a fee that has to be paid. And so sometimes people really don't like to pay that fee because that fee is, pretty much per dollar. Or per unit of currency that you're buying. So even that fee can end up being quite a significant number. And so people don't like to do it. But if, like for example, in Jane's case, it was very much worth her while to buy the futures contract. There are some other ways to hedge foreign currencies, and this can be done internally. And a lot of this has to do with changing, the timing of your payment. So let's say, for example, if you think that the other currency is about to rise and is about to get really, really expensive, well, you can just pay in advance and say, hey, can I just make my payment today? That's one way of hedging yourself. Another thing is if you find out that the price of the currency is probably going to be going down, then you can do a lagging expenditure. So lagging expenditure means that you request the other party that you want to pay as late as possible. It's always good to net your receipts and payments. So if you're dealing with many different currencies, it's always good to see what your net exposure is in every single currency that you're looking at. So what is your the amount that you're expecting in each currency, and what is the amount that you need to pay out in each currency. And once you know your net exposure, then that's also, it's very important to do that, to net your receipts and payments out so that you can really hedge yourself if there's about to be some sort of major fluctuation and you have a high exposure. There are several instruments in the market of derivatives in the market that can be used. I have spoken at length about the forward contract, but there are some more. There is the currency swap, and in this case, basically, two parties in two different countries, they each take a loan of a certain amount, and they in their home currencies, and then they basically trade the cash at on a certain date in the future. They decide to make a currency swap at a certain exchange rate in the future. So this is another way of hedging. There are other options. There's foreign currency options, the option to or right to buy or sell a specific amount of currency at a specific price at a specific future of time. So these are foreign currency options that you can buy. Also, there are spot contracts. Spot contracts are basically contracts that are completed between 1 and 3 days, very short duration. And so this is, spot contracts are done just to really avoid, any sort of exchange rate of fluctuations. So you can also place spot contracts and find out what the spot rate is and work that out as well. And that's done in the short run again, between 1 to 3 days. So that's basically what I wanted to talk to you about, managing currency issues and currency fluctuations and all of that. Next up, I want to talk to you a little bit about managing working capital. And, I've spoken to you guys at length by now about the cash conversion cycle. I've spoken about how it's so important for companies to have working capital. If they start running out of working capital, many times they need to go to banks to sort of borrow money, and that borrowing of money can be very, very expensive. So this can add a lot to any company's cost and can lead to serious cash crunches. And if they don't have cash, they can't make their payments and all sorts of issues. And so in many, many cases, it's not that companies are not profitable, it's just that they run into serious working capital issues. So very important for companies to manage their cash. Now, let's talk about, global supply chains. As we know, there's so many different parties involved. And this is just, a cash flow model of a typical company. And, you can see over here that, there's a reasonable amount of time given here, 10 days, 14 days, 6 days, 21 days. These seem reasonable. But what can very easily happen is, let's say your goods are on the ship, you're expecting the ship to reach its destination 10 days. Well, that can become 40 days on the ocean. Raw material, you were expecting it to reach you in 14 days, it can reach all the way up to 60 days later. And so what seems to be, a reasonable amount of time, of let's say 56 days can actually end up being as much as 160 to 360 days if you are, dealing with international trade. And so, especially with shipments. And so this can lead to serious cash crunches. So if you're expecting a payment in 56 days or 60 days, which is around 2 months, versus you end up getting it a year later, your payment, you can get stuck with a very serious cash flow problem. Now, some companies are better with dealing with cash flow issues as compared to others. On the right hand, on the side, you can see this is Dell. And so Dell actually has a very good cash flow model. It involves, and what they do is just in time. So they use a lot of just in time, which is, they get the raw material only when they need it. So they really reduce the amount of inventory they have. And because of, using just in time kind of methodologies, they actually have a negative cash conversion cycle time, and that's really great, right? Because we know that the lower the cash conversion cycle, the better it is. So in this particular case, on the right hand side, they have a negative 29-day cash conversion cycle. Really great for them. But on the other hand, on the left hand side, as I mentioned, this is a cash conversion cycle of a typical company, and this is full of potential problems that can arise. So these are just some things to keep in mind. Now, the question is, how can you free up your working capital? How can you improve your cash conversion cycle in the short run? There are lots of different ways. First of all, try and lower your transit time. The shipments, try and make sure that they reach as soon as possible. Lower your inventory, increase your cycle time. Try and make your manufacturing as quick as possible. If you end up with excess inventory, return it to your suppliers. Don't sit on it. Make things in smaller lots. Ask your customers to basically pay you earlier, and really be very, very, adamant about getting your payments quickly. So these are some ways to sort of deal with your working capital issues in the short run. Now, if we look at the longer run, let's see how we can, what are ways to free up working capital? Well, several different ways. You can, for example, with your customers, you can say, look, guys, if you pay me early, I'll give you a discount. You can say, you can tell your customers that they can pay by credit card. You can, before things are due, you can reach out to your customers and say, make an appeal for them to pay earlier. Also, in terms, if you are waiting for waiting for a shipment, you can say, look, bill us when we receive the goods. Don't bill us before we actually receive the goods, because we need, you want to hold on to your cash as much as as long as you possibly can. Also, try and as far as manufacturing goes, best thing is to do just in time. Try and have just in time deliveries. Do cellular manufacturing so that you're organized in a really, efficient way. People can get their work done faster. And build to order. Try and have a pull strategy as compared to a push strategy. So these are just some ways, both in the short run and in the long run, to free up working capital. And again, I kind of wanted to sort of talk to you about this and emphasize this, because these are issues that, a lot of companies run into problems with, especially when related to international trade. And as I said in the beginning of this lecture, international trade is becoming really very difficult to avoid. Almost every company around the world is involved in trade. So if you are in the world of import export, you do need to know these things, and you do need to know how to save yourself from some very difficult situations. Okay, next I want to talk to you about international trade payments and something known as the letter of credit, or LCs. I'm sure you all must have heard about LCs, but I don't know if you've had a chance to really understand what they are. So I will just talk to you briefly about what LCs are and why they are used. So as you know, there is just a lot of risk in international trade. And many times what happens is that, there are sellers and buyers that are involved in transactions, but they really don't know each other. And many times they are thousands and thousands of miles apart in different countries, and yet they're going through a transaction. And so the interesting thing is that generally speaking, sellers want to get the payment for their goods as soon as possible, but even before they ship anything, a seller would like to get their, payment in advance. And buyers usually like to delay making their payments. They would like to make the payment only after they have received their goods. So this is a kind of a conundrum. It's kind of a funny situation going on. Now let's look at methods of payment in trade, okay, in international trade. So there are basically three ways that are used in international trade to make payments. The first one is cash in advance. So right before, even before the goods are received, the buyer says that is told that they have to make a payment in advance. Now, this is a very high risk for the buyer because they're paying for something they have not received. And so, but it's great for the seller. So here you can see it's very low. Seller's risk is really low, but the buyer's risk is really, really high. On the other hand, there is a situation where sometimes the transaction is set up in a way where it says, no, it's going to be open account, which means that only after the goods are delivered, the payment will be made for the goods. So this is called an open account. Now, open account is really great for the buyer because they would have received, they would have been able to hold on to their cash for a very long period of time. And only once they receive their goods would they actually make the payment. So that's called an open account. Now, both of these situations, you can see these are kind of extreme situations, but there is another third way out, which is which involves using LCs or letter of credit. And I'm going to talk to you just a little bit about the LCs. And basically, in this particular situation, in the case of an LC, a bank is involved. And usually it's the buyer's bank that is involved. So the seller is not going to be working directly with the buyer. They are going to be working with the buyer's bank. And the buyer's bank says, look, you give us the certificate that the goods are on the ship, that they're about to reach. And at that time, we, the bank, will make the payment. So even if you don't know the buyer, don't worry about it. We're the bank, you can trust us. And so that's what is used in many, many situations. I want to just kind of talk to you a little bit more about each one of these situations, the cash and advance payment. Again, this was a situation where goods have not been received, but the payment is made in advance. Now, this is sometimes done for new customers, or it could be used, this payment could be used with a customer that has really bad credit, or they're coming from a very risky country. So in such situations, many times the buyer can be like, sorry, the seller can say, look, you're a high risk kind of a client. I'm really sorry, but we need the payment in advance. Now, if that happens, the importer has all the risk. The buyer has all the risk. They have to make the payment before they're even receiving the goods. And it's great for the seller because they have no risk of that the buyer won't pay. The problem is that a lot of customers may say, look, this is very difficult for us to do. We don't want to work with you. And so sometimes, you do lose customers if you really insist on cash in advance payment method. But in other cases, if it works, great for the seller. The next one that I kind of spoke to you all about was the open account payment method. And again, this is great for the buyer because they receive the goods and only then will they make the payment. The seller has all the risk though, because the buyer can at the last minute say, you could have sent the goods, and at that time the buyer may say, no, I'm not paying. If you use an open account payment method, it really does help with boosting your own competitiveness in the global market. People would be very happy to work with a company that excuse me, has an open account payment method. It's a great way to really establish a good trade relationship, but it exposes a company a lot to the risk of non-payment of the buyer. And so sometimes they have to do additional, they have to try and take additional steps to sort of ensure that, what's going to happen if the buyer doesn't pay up. So they have to make some take some risk mitigation measures, and that costs money. So again, you see that, both of these are kind of extreme cases. And that's why letters of credit is what is used very often. And as I kind of just mentioned, letter of credit is basically a document that is issued by the buyer's bank, and it assures the payment to the seller provided certain documents are being presented to the bank. And so documents must prove that the goods were delivered. So once the bank knows that the goods have been delivered, then at that time the bank will make the payment. So again, there's less um, risk that the buyer won't make the payment, because now the buyer's bank has agreed that they will be making the payment. So that's why a lot of people say, open an LC. And so there's a lot of, if you go to any bank, there's the trade finance department is a very busy department. And, I used to work in a bank once, and whenever I was used to visit the trade finance department, they were always, talking about, oh, okay, this person needs an LC open, that person needs an LC open. There was always a buzz in that department. So again, the risk is transferred from the seller to the buyer's bank. And when you open an LC, the buyer pays a fee to the bank. Now, this is a little bit of an issue, because the buyer, in the other situations was not having to pay a fee, but in this case, they do need to pay a fee. And so to the bank, the bank also needs to know that this buyer is trustworthy. Otherwise, they won't open an LC for them. So banks, again, as I mentioned, there's a lot of activity. This is how they make money, even if it's a small amount of the transaction, small percentage of the transaction fee, it does add up. So LCs is a great business for banks. So yeah, very important to know this and to understand why a lot of people end up opening LCs. Finally, I'm going to wrap this lecture up by talking to you just a little bit about global supply chain design strategies. And interestingly enough, some transactions are actually made in the waters, in international space or the sea. And I'm going to talk to you just a little bit about this. What happens many times is if companies like to avoid paying taxes, and what happens is if you have a permanent establishment in any country, and a permanent establishment basically means you own inventory or you own property or anything that generates value. You, let's say, have some employees. In that case, you have a permanent establishment in a country. And so every country likes to charge income tax. And so many times what happens is that, in order to avoid that, and so this is again, this is just what I just mentioned about the permanent establishment over here. So many times what happens is that companies actually go into the water, into the international space to make a transaction, and the buying and selling actually happens in international waters or airspace. Now, if the transaction does not happen in a particular country, then you only have to make payments to the manufacturer's home country. So this is basically done. So for example, what happens to avoid excess tax and all of that, in case, this is also called an outsourcing shell game. So in a simple case, a manufacturer doesn't want to pay taxes in two different countries to make that transaction, to make a transaction which minimizes their sort of the total amount of tax they're having to pay, they decide to do it in international space and international waters. I don't need you to know, go into too many details, but I did want to sort of point out that this is something that is done. Also, sometimes what happens is that even if sales are made in the same country, they decide to execute the transaction in international waters, could be in a warehouse or a bonded warehouse of some sort. And so they try to sort of execute the transaction in international sort of waters. People like to do this because if transactions are being kind of done in a particular country, they are liable to pay more taxes. So I kind of just wanted to point that out to you, and that this is yet another option in international trade that some companies decide to pursue. With that, bring this particular lecture to an end. I hope you learned some interesting things about international trade, and hopefully these things will help you in whichever role you decide to work in supply chain in the future. Thank you very much.